So as crypto moves into more of a consumer space, if the fundamental underlying infrastructure is not fast enough to deliver that type of experience that people expect, it's going to have an effect on consumer adoption of crypto. I think we're on a trajectory pretty quickly for the majority of payments that are for non-physical goods, where they're like just straight up consumables that are delivered basically instantly. I think we could see that stuff settling in a few hours.
Welcome everybody. I have an amazing guest with me today, Austin.
Hey.
How you doing?
Good. How about you?
Doing great, thank you. Before we jump into DoubleZero and all the amazing stuff you guys are building, I want to kind of like take a step back and ask you this very, maybe simple question. What does PayFi mean to you? And why do you think that's, an important category and a growing category within the Solana ecosystem?
Yeah, I think when I first kind of started hearing the term kicked around, like most things in crypto, it was named in a weird way that I'm not sure necessarily made a ton of sense. And so people were talking about, these ideas that you can buy something and then your staking rewards can pay for it. And and it's like, okay, well, this is just an endowment. This is a fancy term for like an endowed fund, right? Where the interest throws off a certain amount and you use that interest to pay for stuff. And it felt kind of like a little bit of a repackaging of just stuff we've already had before, but with an extremely volatile asset class, which doesn't typically lend itself well to the type of things people talk about with PayFi. But you get into a bit more, and really what it is like most modern payment systems are built on a lot of trust, right? There's lots of proxies for trust. Your credit card number is a proxy for trust. Your credit score is a proxy for trust. Your social security number in the United States is a proxy for trust. But a lot of these systems end up working with settlement that is significantly later than the actual payment transaction, whether it's pre-authorizations on a credit card or the time a wire transfer takes to clear or any of these types of things. And so it really is about, payments has always been a mass size, very low margin game. And it's kind of about increasing that margin spread by reducing a lot of the trust assumptions you need in traditional payment systems. And if you can do that, if you do that at scale, you can knock 50 basis points off the cost of payment processing. And that doesn't sound like much to a consumer, because to a consumer, it's not much. But to a business or to someone who's processing a huge volume of payments, that is hundreds of millions of dollars a year in savings.
That is hundreds of millions of dollars of savings. That's actually a great angle to look at it. And you mentioned that, there are extremes in payments, but they all are revolved around, factors of trust. And you have wire transfers that cost a lot of money and takes forever and goes through so many hubs that are unnecessary sometimes. And then you have the card auth, for example, that usually happens within 8 milliseconds.
Yeah.
And you guys are trying to actually make the blockchain infrastructure as fast as possible. Can we get to that level, that 8 milliseconds or under auth level, so that actually we can get auths through the network?
Yeah, so, it depends, right? Like, we look at 8 milliseconds and we're like, we've got blockchains with 10 millisecond block times now. Solana's basically got 10 millisecond block times with its inter-shard, tick marks, basically. But at the end of the day, what is 8 milliseconds? 8 milliseconds is not really enough time to get from New York to California.
That's right.
Right? And so when we look at what makes payment authorization sometimes fast or sometimes very slow nowadays, a lot of it has to do with having multiple ingest points for that authentication to take place. If you're always running back to the same server in California, you are not getting 8 millisecond payment authorizations if you are swiping a card in Istanbul.
Yeah.
Right? It will take longer for the speed of light to actually get there. Now, you may have a response time of that system of when it receives data and it says, okay, we need to process this. Is this approved or declined? That can be a fast response, but physics is one of the main limiting factors for how quick we can have global systems operate, which is where distributed systems start to really matter and take effect, right?
Yeah.
And so, what we're building with DoubleZero is a global high-frequency data network, basically. It's a physical fiber network that gives deterministic latencies and guaranteed bandwidth to all sorts of high-performance decentralized systems. And you can build all sorts of things on top of that, from payment networks to flash storage networks to the entire Solana validator set. And so our focus is really building very low down in the stack. We're not building tools that payment companies could use, but we're building things that people could build tools on top of that then payment companies could use, right? It's sort of the way to think about it. And so we're starting with the lowest level of the stack possible. And it really is built for all types of high performance distributed systems. You could see someone building some sort of, proof of authority network that runs on top of it that is just designed for approving and declining payments based on balances on other networks, right? And suddenly you have 20 of those all around the world. You've cut your latency down significantly if they're globally distributed. So there's all sorts of different types of things you can build on top of fast infrastructure, but fast infrastructure really is the key to making all of these sort of systems that start to compete with Web 2 actually work, because Visa runs a pretty damn good payment network.
Yeah, it
right?
works really well. They oiled it for many years.
Yeah,
right? So
it works really well. And, when you get into the whole process of a credit card, it's pretty expensive at the end of the day.
That's right.
But the performance is there. The downtime doesn't exist, right? It works in pretty much every country in the world.
You pay for the convenience, right? At that
sure.
point.
And well, the merchant pays for the convenience, right? Not the consumer. The consumer credit. This is like one of the biggest problems with PayFi is that it's the merchants that pay the cost, and so it's hard to move consumers over to do. This is, I think, the only reason why stablecoins haven't taken off as the dominant payment form in the United States is I get a lot of Amex points.
Yep.
And I also don't get a discount with the merchant if I use a debit card or use stablecoins or something along those lines. So it's this very interesting game where the merchants are the ones that pay the cost, but the consumers are the ones that choose how to pay.
We actually have a thesis on this. We think that it's actually very, very hard to get a daily use case, an everyday, person, my mom, shopping, to use stable coins directly. But if you can convince the merchants of the benefits of settling in stable coins, then the payer actually sometimes doesn't even need to know that they're using stable coins. They just need to use the right payment application, the right payment service that settles with the merchant in stable coins. So I think you're touching something very interesting, where we also believe you need to start from the merchant networks to really change things.
Because if you look at it from like my perspective, paying with stablecoins is a terrible deal for me.
Yeah.
I have to pay instantly, and I get no discount, and I get no points. Right? If I pay on my Amex card, I have to pay that thing for 30 days.
Yeah, and then you get some free flights to Istanbul.
Sure, right? You get free flights to Turkey, especially, being in New York, they give out free flights to Turkey all the time to people in New York, it seems like. But, even from that perspective, it's like, well, we got 5% treasury yields nowadays. I'm going to keep that money in an account for a few extra days. And so, but on the merchant side, this is the power of the Starbucks payment app, right? Is they're like, oh, preload a bunch of money from your bank account, we'll give you $5 of free coffee. And you're like, all right, well, sure, why not? Suddenly we've switched the plot where the benefit I get by going through the merchant's preferred payment system, which reduces the cost for the merchant, actually gives me some benefit as a consumer. But you have to be the size of Starbucks or a large company with enough payment volume to get there.
Yeah, you got to start. You got to start from where the distribution is on that side, and I think that starts moving things. Fascinating. Maybe walking a little bit back from there. A decade ago, I founded a project called Internet.org as part of the Meta team, and at the time, we were trying to do something similar, but more for the kind of social media internet or media internet. Trying to figure out how to bring high quality, high speed internet to the masses, because we realized that that's the bottleneck. That's the bottleneck to the internet. That's the bottleneck to applications. That's the bottleneck to providing great experiences. Either is for Facebook or Instagram or for WhatsApp or even for people who want to access online education or Wikipedia or just simply anything they want to look for in the internet. And we realized that, while we were thinking, should we build solar-powered drones and, should we do BBRCs,
I remember Project Loom.
Yeah, Project Loom. We played with lasers. We played with all sorts of crazy things. We built as this open Wi-Fi architecture. And we realized that, it's very hard to build consistently high quality, high speed internet because the physics are not the same all around the world.
Yeah.
Which is a very weird, maybe thing to say, but that's the reality of the world as we start visiting these different, parts of the world and just doing measurements and trying to understand how everything works, especially if you're trying to create this for mobile experiences as well. The physics work very differently. And the limitations of the physics are very, very different, everywhere you go. And then we also, discovered this underground world of, fiber black markets.
Sure.
Which apparently is a thing, and you have to sometimes go through some pirate schemes to be able to figure out like how to increase bandwidth in certain parts of the world. And, there are people who hold hostage those cables. It's just like, mind-blowing stuff that we have discovered. So going from there, because we didn't really need to make everything consistent, right? Like you can load your Instagram in 3 seconds or 1 second or 10 seconds. Doesn't necessarily make a huge ton of difference, but it makes a lot of difference to not have the consistency when you're trying to provide, high throughput payment experience or, hyper trading kind of like, solution desk. How do you get the consistency in such a distributed system?
Yeah, I mean, a lot of this is just bypassing the internet, right? This is something Facebook learned very early on, which is like, if you want to sell ads to people in the Philippines, first you have to run undersea cables.
That's right.
Right? And that's what they did. They spent a ton of money wiring up the Philippines so they could sell people ads. And there's a lot of other stuff about like, oh, we're going to get people online, but at the end of the day, like Facebook is an ad tech company, right? And so that was necessary in order to do that. And then Facebook is now Meta now is one of the biggest investors in undersea fiber, right?
Yep.
Like I think they've surpassed Google and Amazon at this point.
Yeah.
And those cables, it's an interesting model because they're largely consortium cables, and so they're providing 80% of the financing and they get 80% of the capacity, but then other people can sort of buy into that as well. And it's eventually, if DoubleZero gets to a size where its treasury allows this to take place, we'll be joining cable consortiums as well. So we have ownership stake in these undersea cables. But fundamentally, this is where dedicated bandwidth comes in, because as you're talking about this jitter, this variance in latency that takes place is a real killer for high performance systems.
That's right.
It's even a killer for e-commerce, right? There's all these studies that are like, oh, if it takes half a second or 1 second for when you click on something in Instagram shopping to load, like your conversion rate goes down by like 50%, right? So even when we're talking about like consumer internet type stuff, like this really matters. And so as crypto moves into more of a consumer space, if the fundamental underlying infrastructure is not fast enough to deliver that type of experience that people expect, it's going to have an effect on consumer adoption of crypto, right? If you open your SolanaFloor wallet or your Phantom wallet, and like every once in a while this happens, and just like it takes like 2 or 3 seconds to load as opposed to the normal like quick instant like, oh, here's how much money I've got. You're kind of like, close tab. Like these effects on us, like we're so like just Web 2 has done such a good job of delivering instant performance that we kind of expect that from everything now. Like remember when like chipped cards came out, and for whatever reason they just took like 2 seconds to process, and everyone was like, screw this, like I'm not going to use this thing. And they like the credit card companies had to go back and spend so much time and money being like, okay, how do we shorten this thing? Like this is a really bad experience.
It's a Trump experience.
Yeah. Yeah.
Yeah.
So
maybe going from there to the last 2 talking points. One is obviously you have to focus on the consumer experience, and this has been the case for the traditional payments as well. That's why merchants are taking the shorter stick, because the world is convinced that if you incentivize buyers and the consumers, and if you give them a great experience, they will buy more, they will spend more, and the merchants eventually will be happy.
Yeah.
And usually those systems convince the merchants to pay for the whole thing, and they take a big portion of the profits, and then the consumers are happy because they have the convenience of the payments and shopping, and then the merchants eventually are happy because they get to sell their goods. However, as we dig further and further into this, we're realizing that merchants aren't so happy about this whole ordeal, especially when you have more and more competition in the world of suppliers, and margins are thinner and thinner, especially with the tariffs blooming every single day. Sometimes they might just lose the whole business because of the economics turning upside down. They are really not happy when Amazon takes forever to pay suppliers in Asia because they have to go from US to UK, need to do some FX operation, takes a few days. Go to a bank in Hong Kong, and then from Hong Kong go to regional banks and the regional payment distribution players, and there's always something getting stuck in between, and merchants just like need to be able to restock inventory or go buy new materials as they sell more stuff. So this kind of like low margin business doesn't really work very well when the payments are always delayed for them. And this kind of like the world, we are saying that actually needs to change. And we ask this question to ourselves, as a fun prediction, but also to challenge ourselves. When do you think we'll get to a point where majority of the payments in the world are going to settle within a few hours? Not even it doesn't have to be milliseconds, because some transactions are complex. You need to do like FX transactions, whatever, and move things, and sometimes you need to get into fiat or whatever, and then for that reason banks need to be able to accept and settle in stable coins. But when do you think, given where we are, things will get to a point where majority of the money moving around the world is going to settle today?
So I would say we have to exclude anything that requires escrow from that, because that skews those numbers, right?
Exactly.
The majority of large payments are like, okay, maybe I pay you in stable coins for goods coming from Asia, but that doesn't actually settle for 6 weeks until the container ship arrives and it clears customs and I sign my thing, right? So if we set those sorts of things aside, I think we're primarily dealing with like maybe 2 or 3 different issues preventing this from getting much larger. The one no one pays attention to is payroll.
Yep.
On-chain payroll is, like, we have seen some companies experiment with sort of daily worker payouts. Companies like Walmart now offer you the ability to do that. They work with some companies, but it's all basically short-term loan payments, right? It's like, here's a 0.5% interest loan on your payment to get paid every day. And so a lot of these things end up being like just very tech-enabled payday loans, as opposed to being like real, true payment settlements. I think one of the problems right now is like, there's a few ways to look at this, right? One is like, this is a market inefficiency, right? There's all this money held for a long period of time. The other is like that float is also what keeps a lot of businesses solvent. So if you have to pay for everything, there's a reason that like net 30 is like a term, right? There's a reason that like people put things on credit cards. Whether they should or not is a different story, but like, I, like, for example, my stepbrother is a like carpenter handyman type person, and so like he has this whole thing where like he goes to Home Depot and he buys stuff on a credit card because he hasn't been paid for the job yet, right? And then he's got like, X amount of days to complete the job, and like that float actually is a feature, not a bug. And so I think what we're really looking at here are like not payments that involve the physical world. I think it's going to be a very long time before those types of things really move into like very quick settlement, because float and escrow are like actually efficiency points in the system, weirdly. But when we look at like digital payments and digital transactions, those are the ones where like I don't see any reason why those shouldn't be moving to basically instant settlement very soon, because it's bad for the merchant if they're running into that type of situation where they don't have payment assurances, but suddenly you've the NFTs out of your wallet, right? The digital software license is gone, the music has been bought, whatever it is. So I think we're on a trajectory pretty quickly for that. I would say within the next 5 years, the majority of payments that are for non-physical goods, or they're for things like coffee, where they're like just straight up consumables that are delivered basically instantly, I think we could see that stuff settling in a few hours.
I love that. Funny enough, we were actually one of those service providers who built the Walmart solution.
There you go.
The Huma founding team actually was the team behind Earnin.
Yeah, okay.
And we did payment advances with just a small fee, basically, that you pay, and that's settled, in a few seconds in your card that you make payments with, and people were extremely happy.
Yeah.
And we learned that, to your point, float is a feature for the business.
Yes.
Right? If a business can delay paying forever, they will delay paying forever. And that's why startups usually, quote unquote, pay in stock options versus actual salaries, because, they just want to be able to manage that float very well, and they promise you a bigger payout later on in the form of stock options. And it's a very efficient form of payment for the startup. But at the same time, for people who are not getting a stock option, and people, in the larger service industries and the productive space, they don't necessarily see it as a, as much of a productive maybe utility, because they feel like when they need to access the money, we have seen cases like people need to put gas in their car to get to work.
Right.
They don't have the money to put gas in their car to get to work. If they swipe the card, they'll get charged $40 of overdraft fees right at that point. They need to make a conscious decision. Am I going to make more than $40 today for the swipe to make sense,
Right.
so I can put gas. So
Yeah.
at points like that, right, like it becomes such a lifesaver to pay actually a few dollars to get access to your paycheck, you know,
Yes.
right away. So instead of paying $40, you know, you're able to put gas in and then go to work. And then there's a downstream effect of that, which is if you can't do that and get to work, you can't pay the rent.
Yep.
You might get basically pushed out of where you are. You need to go to a motel to stay. You're paying more than what you're paying for rent. Now you need to actually, you know, go and work, you know, over
Yep.
over hours to be able to make up for it. So we believe there's always a product when there's demand on one side. Right? It can be a feature to your point, and maybe companies will benefit from new product solutions that give them basically, you know, just keep your money forever. And then we'll take the risk. We'll give you, we'll sell your financial product that you can pay us in different ways, but you keep, you know, your float, and then you can have another financial, you know, service that can provide a solution to the, you know, workers, and benefits them in some way. So you can always, it's interesting that in finance, create a lot of derivatives that serves different people, even though the system, you know, powering it all is powered by the same money supply in some ways.
Yeah, and this is the thing where, like, with stablecoin payments that, like, and this is where I would say sort of like the next generation of PayFi gets like more interesting, because like there's this world where like the stablecoin regime, if it's just stablecoins, it gets very close to hard money financing.
Yeah.
And hard money financing is incredibly capital inefficient, right? It's like, oh, like you see this in New York sometimes. There's like some projects that for whatever reason they're hard money finance, and it's like, oh, they built that entire $300 million skyscraper in cash, right?
Yeah.
And like, yes, now many people have ownership stake in it, but like that is a very financially inefficient way to do construction, right? Unless you're trying to do things like avoid any financial risk on the thing.
The funny thing is, before the Trump admin, there was a financial scheme in the United States to get foreigners to actually fund these projects. I'm pretty sure you're aware of it. A lot of, you know, people, especially in Asia, were sold projects in New York to, you know, provide cash for in exchange for potential green cards. So
Yes.
it was a
Yep.
very interesting, you know.
Oh, exactly,
way of
right?
getting funding.
There's all these sorts of things, and so, you know, I think this is one of those interesting ones where like it would be interesting to see sort of, you know, PayFi products for like citizenship and residency and like work permits, right? Which is an interesting one because a lot of these systems are like, oh, we'll give you a work permit if you can prove you have 9 months of living expenses or something in this like city. And there's a lot of interesting interplays with governments where you can just like bond stable coins and get yield on that, but also like that is your reserve to prove that you have, you know, the ability to work in this area. So I think the minute PayFi gets more interesting to me is when it gets started to integrate with like public policy. Like I think the stuff that Andrew Yang was talking about with Borough Bucks in New York City a few years ago about switching like government food stamp programs over from these sort of like, oh, spend it at Walmart, spend it everywhere, to like, no, you can actually only spend it at businesses in your neighborhood.
Yep.
And maybe we're going to give you 15% more because we know those prices are slightly higher, but it creates like much more circular economy dynamics as opposed to these sort of like, okay, great, like I paid some money to like the Walmart and now it's just gone to Arkansas, right? Like it doesn't actually stay in that community, whereas like if you're spending it at a bodega, like it does. And so I think there's a lot of room for stablecoin and like local stablecoin technology to start interfacing with public policy and actually create things that are better on all fronts.
I love that. There's actually a company I met here at Solana Crossroads who is working on something like that.
Oh, nice.
I was so fascinated. It was called, I think, Flinch, if I'm not mistaken. They are trying to create this kind of economy by working with different neighborhoods, you know, cafes and shops, and it's just amazing. Just, you know, helps keep track of things, but also, to your point, helps reward people for spending their kind of credits, you know, in the right places as well. So it creates, you know, the circular economy, which is very, very important. Otherwise, I think we'll start losing neighborhoods more and more.
Yeah.
This was fascinating. Thank you so much for, you know, having this conversation with me. Any last remarks? Maybe like when DoubleZero?
Yeah, I mean, we have a testnet up and running now, and we're looking at launch in Q3.
That's amazing.
Pretty soon.
Looking forward to it.
Thanks.
Thank you, Austin.